This is Macro Horizons, episode 351, A2 Santa Pause, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of November 24th. With the tune Santa Pause is Coming to Town stuck in our heads, we're actively working on our holiday list. Payrolls, nice. Unemployment rate, naughty. CPI, nice. AI, naughty by nurture. Get it? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, by far the most important data release came in the form of the September non-farm payrolls print, which increased 119,000 jobs. This was well above the consensus, which was for 51,000. In addition, the three-month moving average for headline payrolls increased to 62,000 from a downwardly revised 18,000. On its surface, the payrolls report should have been a net negative for the Treasury market. However, on the other hand, what we saw within the details was an unexpected increase in the unemployment rate to 4.4%. On an unrounded basis, it was 4.44%, which effectively means it was close to rounding up to 4.5. Even as it printed, it was the highest unemployment rate since October 2021. Taking some of the edge off of the higher unemployment rate was the fact that the labor force participation rate increased 0.1% to 62.4%. However, at the end of the day, when combined with the net revisions of negative 33,000 over the prior 2 months and a benign average hourly earnings print of 0.2%, the Treasury market rallied on the information provided by the employment report. Now, we'll argue that a lot of that had to do with the departure point ahead of the data. For context, the futures market was pricing in just a 25% probability of a December rate cut on Wednesday, and in the wake of the payrolls data, those odds had increased to 40%. Now, it's clear that within the employment report, there was something for both the hawks and for the doves, and so we're viewing the release as inconclusive as it relates to December. At the end of the day, we suspect that the path toward a December rate cut not only just got narrower, but will also largely be a function of the ability of the doves to convince the hawks that another quarter point is warranted before year end. Regardless, the data for September seen thus far, which includes CPI and non-farm payrolls, suggests that even prior to the government shutdown, the employment landscape was cooling and inflation remained benign. Next week, we will see the retail sales figures from September, which will provide context for how a softer employment outlook and benign inflation have been translating through into consumers' willingness to spend. The week just past also included the FOMC minutes from the October meeting. The takeaway here was that it was a close call to cut 25 basis points in October, and there was already pushback against moving in December. All of this reinforces our perception that it is a 50-50 call as to whether the Fed will cut in December, and the BLS's decision to delay the release of the October and November payrolls reports until after the Fed meeting sets us up for a period in which incoming Fed rhetoric is particularly useful, hence the market's willingness to take the FOMC minutes as a key input to repricing the front end of the curve.
Well, it was a payrolls Thursday to remember. The first NFP release since the government shutdown showed an upside surprise to September's headline hiring, but beyond simply the headline payrolls gain that outpaced expectations, what we saw was 33,000 jobs removed on a net 2-month revision basis and an unemployment rate that has now reached its highest level since October 2021. Part of that was driven by an increase in the labor force participation rate, but nonetheless, there was enough underlying softness in the September jobs numbers to trigger a bull steepening reaction in the Treasury market as Powell remains in a precarious position as it relates to December's rate decision. It certainly wasn't a disastrous month for the labor market in September, but nor was it so strong that it's obvious the Fed doesn't need to cut rates again in a couple weeks. And so, for better or worse, the market remains in wait-and-see mode. We do get more economic data, importantly next week's retail sales print, and then obviously ADP with more jobless claims data to be revealed before the December meeting. But we also learned that October and November's payrolls reports won't be released until after the Fed. And so that heightens the relevance of what would otherwise be second-tier data in determining what will ultimately come to pass for the final FOMC decision of what's been an undoubtedly exciting 2025.
One of our biggest takeaways from the mixed jobs report is, as you point out, Ben, there were pockets of weakness and concern, and that predated the government shutdown. So as we ponder what happened during the 6 weeks in which the government was shut down, it's difficult to envision that that was a net positive for the labor market and the hiring profile, particularly when coupled with headlines about significant layoffs and the general sense of uncertainty created over the course of the last several months. Now, the case for a pause is relatively straightforward, and it simply holds that some of the tariff pass-through and the upside potential for inflation has yet to be realized in the actual data. Now, we won't know until after the Fed decides what the November CPI figures look like, and that has triggered the conversation about whether or not the Fed should consider rescheduling the meeting. Now, we don't expect that this will happen, nor would history suggest that it's truly an option, but the logic behind waiting to see until we have the actual data to make a decision certainly does resonate. In practical terms, the Fed will meet on the 10th of December, decide what to do with rates, and publish their widely followed summary of economic projections, including the beloved dot plot. And those forecasts will have a relatively short shelf life, given the fact that the BLS will publish both payrolls as well as inflation updates in the following weeks.
And we heard the observation offered this week that almost regardless of what comes to pass in terms of the actual FOMC statement, you're going to want to take the other side of that as Powell takes the podium at the press conference. Because in the event that Santa Claus ultimately does come to town, then the Fed will probably opt to walk back that relative hawkishness by delivering either a relatively more dovish dot plot or by Powell saying that, yes, December was a skip, but monetary policy is still restrictive, the Fed is still intent on bringing rates lower, and that means that we're going to get more rate cuts in 2026. There's also the argument to be made that this avenue would introduce a potential policy error response, as the Fed not following through with a cut would only add more angst to an already wobbly risk asset market, with everything that means for the potential tightening of financial conditions that in turn would need to be offset by Powell saying, yes, no December, but we're looking at January and we're looking at March as well. Conversely, if in fact we do get a December cut, the framing around that decision will be something along the lines of, we don't have all that much information, we decided to cut as an insurance measure to get policy closer to neutral, but going forward, depending on how the data performs, it's not a foregone conclusion that January or March are going to need to see rate cuts as well. And so it's this dynamic that makes the December FOMC a far more exciting Fed meeting than any of the ones in recent memory, simply given the setup with the Treasury market setting up to approach the event at the local yield lows and the curve at basically its steepest level since the summer. And so while there's still nearly 3 weeks until the meeting for expectations to be refined, there will definitely be some back and forth dovishness and hawkishness to be realized through the FOMC itself.
It will be interesting to see how the Fed chooses to refine its messaging in the week ahead. Recall that starting on Friday at midnight, the Fed's self-imposed period of radio silence ahead of the meeting commences, which means that the market will have the information contained within the retail sales print for September, as well as PPI and the weekly claims data to refine expectations and any nuance that Fed messaging can add to that. it's worth pondering how the Fed might respond to a market that's pricing 50-50 on the eve of the decision itself. At the end of the day, we suspect it comes down to the ability of those more dovishly minded on the committee to convince those in the pause camp of the merits of continuing the path towards a normal policy rate. We're also expecting an increase in dissents in either direction. Whether there's a pause or a rate cut, we suspect that those with opposing views will be particularly vocal. If for no other reason, then we're running up against the end of Powell's term, and those Fed officials looking for a bit more of the limelight might use this as an opportunity to promote their narrative of what's going on in the real economy.
And we've made it this far in the conversation, and I hate to bring it up without mentioning the performance of the equity market, and what's looking to be an increasingly uncertain outlook for risk assets broadly as we head into the end of the year. The business investment story around AI and data centers and some marquee tech earnings releases this week is hardly a new narrative, and obviously the S&P, still well into positive territory on the year, is not the type of equity market price action that would justify a monetary policy response. But it has been telling to see that the number of client conversations we've had over these past few weeks is increasingly centered on stock valuations and just how much downside will be realized if there is a bit of a rationalization of some of the AI exuberance that's driven equities to these levels. Extrapolate that backdrop onto an FOMC decision where the Fed may in fact choose to hold rates steady, and it's not difficult to draw the correlation to periods of monetary policy cycles past, where heading into the end of the year, there's risk-off impulses that the Fed does not react to, which only then exacerbates the risk-off move, heading into December 31st, only to have a relatively quick, dovish about-face from the Fed early in the year. Now, it's certainly too soon to say with any high degree of conviction that this is what's going to play out between now and New Year's Eve, but it's certainly fair to say that the U.S. rates market is increasingly looking at the equity market for guidance.
So clearly, implicitly, this is a circular feedback loop, and that's not that surprising, given that we're coming out of 6 weeks in which there's been no official economic data, and the data that's on the horizon, macro or otherwise, will continue to be viewed as distorted, at least until we're into 2026. And let us not forget, we're running up against the period in which the administration has suggested that we will learn who Trump's nomination to replace Powell will ultimately be. We're viewing most of the candidates that have made the short list as net positives for Fed credibility, for the institution as a whole, and frankly, likely to be good leaders. Now, while there's always the risk that the market perceives Trump's nominee as particularly loyal to the administration and biased towards not neutral but an outright accommodative monetary policy, at the end of the day, we're relatively optimistic about credibility at the Fed as an institution and the performance of the committee in the best interest of the real economy as a whole, as monetary policymakers attempt to balance the risks of the highest unemployment rate since October 2021 versus the potential for tariff pass-through to materialize in the coming quarters.
And almost regardless of what comes to pass in terms of the data we get between now and year-end, it's safe to say that December is not going to be a month that reveals a great degree of clarity in terms of the economic outlook, and frankly, it's unlikely that January or maybe even February will as well. The impact of the government shutdown, which is obviously growth negative, but will also be distortive around aggregate jobs numbers, and what that means for consumption, for consumer confidence, is going to linger beyond the holiday season, and probably mean that even in February, when we're getting January's economic data, there's going to be caveats and disclaimers around the information that is revealed, and we're likely not going to get a quote-unquote true sense of how the economy is performing until the later part of the first quarter or even early in the second quarter. This, unfortunately, coming at a time when the monetary policy backdrop is also in flux, will naturally translate to a period of less certainty and higher volatility, and it's precisely these environments that even from these yield levels leave us constructive on treasuries heading into the final weeks of the year.
All this begs the question, if one finds themselves driving the car using the benefit of only cracked rear-view mirrors, do you step on the gas or the brake? In the week ahead, the Thanksgiving holiday will effectively mean 5 days' worth of trading condensed into 3. While Thursday's market close is followed by a recommended early close on Friday, in practical terms, we expect that there will be very little activity on Friday, with the caveat that it does represent the final day before the Fed's self-imposed blackout ahead of the FOMC meeting. So if the Fed would like to refine their messaging ahead of the meeting, that would be the last day. And of course, it is month-end, and so there's a potential for any related month-end flows. Earlier in the week, supply is a consideration, with 69 billion 2 years on Monday, followed by 70 billion 5 years on Tuesday, and then capping November's auction schedule will be 44 billion 7 years on Wednesday. We also get the Beige Book, and the anecdotes contained within the Beige Book will be especially important in informing monetary policymakers' bias ahead of the December 10th FOMC meeting. The Beige Book is typically not a market-moving indicator, as we tend to have more official data as we attempt to assess the performance of the real economy. But given the government shutdown and the fact that the BLS is playing catch-up, the Beige Book could prove itself to be particularly informative. On the data front, we have the September retail sales print, where we will be closely watching for any indication that the softer labor market bias combined with the benign inflationary profile has led consumers to pull back as the third quarter came to an end. We also have PPI for September, and given the fact that there are only a couple data points to trade off of, we expect that the inflationary information contained within PPI could prove actionable, as it were. In terms of a trading bias, we remain generally constructive on the Treasury market, although we'll be the first to acknowledge that the takeaway has been that of a range trading environment with a longer end of the curve well contained within the prevailing trading parameters. In 10 years, for example, the 4 to 420 range appears content to hold, at least for the time being, if not the foreseeable future. We suspect that in order to stage a more significant rally, we would need either convincing guidance from incoming Fed rhetoric or a decided deterioration of the economic data and therefore outlook. Activity in the front of the curve remains a bit more nuanced, with 2-year yields effectively a 24-month rolling window of monetary policy expectations. This implies that the debate around whether or not the Fed moves in December will be particularly relevant to the 2-year sector. Now, a case to move to 370 or 375 2-year yields is very difficult to envision in the current environment. After all, even if the Fed does choose to take December off, the prevailing logic still holds that the direction of travel and policy rates is clear and lower, and whoever the president chooses to replace Powell, at least at the beginning of their tenure as the head of the FOMC, will be more biased to cut than not. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. It's a season for being thankful, and we are. For the opportunity to publish Macro Horizons, for the occasional attempt at humor, for all of our listeners, and of course, for the unnaturally rapidly spoken disclaimer. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode, so please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.